Here's a number that genuinely surprised us. At one of Australia's biggest banks, 1 in every 5 first-home buyer loans now goes to someone over 40. Not 25, not 30, over 40. So if you're renting through your 30s, quietly wondering whether you missed the window, this one's for you. By the end, you'll have a readiness checklist that replaces the buy by 30 deadline most of us inherited. We felt this one personally. We got our own keys later than our parents did, and honestly, we spent years feeling behind. Then we read what the banks themselves publish, and the whole story changed. That 1 in 5 figure comes from Westpac's own lending book, reported this January. These aren't rare exceptions or lottery winners. They're a full fifth of the first home buyer queue. Maybe you know the dinner table version of this. Someone bought their place at 25 on one income, and the comparison lands on you like a verdict. We sat through that conversation too, but here's what we wish someone had told us earlier. The feeling of being late is real, and the deadline it's measured against quietly moved years ago. Nobody sent out a memo. So we dug into what actually changed, the bank's published numbers, the census, and national housing research, not to explain the problem away, to swap a vague anxiety for a decision you can actually make. Start with the average. The biggest banks now report their typical first home buyer is around 34 years old. Mid-30s isn't the exception at the front of the queue anymore, it's the middle of it, and it's been building for decades. Housing researchers found the average age at first purchase was about 26 in the late 1960s. Today the banks say 34. That's not a blip, that's a half-century drift. A quick honesty check, because we'd want it too. These averages describe each bank's own customers, not a national census. Broker networks quote a touch higher again. Treat the figures as direction, not destiny. Each generation has entered home ownership a little later than the one before. So if you felt like the goalposts moved during your run-up, you're not imagining it. The data agrees with you. Here's the reframe that helped us most. Ready to buy was never really an age. It was a bundle, a deposit, a steady income, prices within reach. The age was just when that bundle used to arrive. Around 27, the old template went: finish study, land a job, save for a few years, buy something modest near work. It worked because the maths underneath it worked. The template wasn't wrong, its era just ended. At 35 today, that same bundle gets assembled around a life already in motion: rent, student debt, childcare, career moves. Same goal, completely different obstacle course. And none of those things are detours, by the way. They're the actual life the deposit has to be built around. Which is why the plan has to fit the life, not the other way around. Bank economists point out today's typical buyer is older and often earning more. Not because waiting became fashionable, because that's simply how long the deposit and the borrowing power now take to line up. Which raises the real question: what exactly stretched the timeline? We found 4 things, and the 4th one changed how we think about every headline scheme. The first is time. Saving a 20% deposit on a typical home used to take around 3 years. Today, property researchers put it closer to 6 years. The runway nearly doubled, and 6 years is long enough for life to interrupt. A rent rise, a career change, a baby, a market that moves faster than the savings account. The timeline didn't just stretch, it got harder to hold. Here's a quieter shift we didn't expect. The average first deposit is now about 16%, not the 20% our parents treated as law. The old rule bent under the weight of the new prices. Picture a couple on decent incomes, renting, saving hard. Every year they save, the target drifts a little further out, and the rent quietly eats the pace. That's not a discipline problem, that's a treadmill. We watched it in our own budget for years. The savings line grows, the rent line grows beside it, and the finish line drifts. Some months it genuinely feels like walking up a down escalator. We lived a version of this ourselves. It's why just save harder advice always felt hollow. The effort was never the missing ingredient. The maths underneath had changed. The second change is the commitment at the finish line. In the big cities, the average first home loan is now about $507,000. In regional areas, closer to $400,000, same deposit percentage, very different weight. That reframed the decision for us. It's no longer just can we buy, it's which market, which size, and which decade of your life this loan gets strapped onto. The third change is who's at the auction. At one major bank, 60% of first home purchases now involve a co-buyer, a partner, and increasingly a friend, a sibling, or family. Solo buying became the exception. Buying together halves the deposit wall, we get the appeal. It also ties two financial lives together. Exits, refinances, and life changes all get more complicated. It's a real pathway, but it's a contract, not a shortcut. The fourth change is the one that nearly caught us out: low deposit schemes. Some let eligible buyers start with as little as 5% down and skip the insurance premium. On paper, that collapses years off the timeline. And these pathways are genuinely popular. Nearly 50,000 households have used the main 5% deposit scheme in just a few years. That's not a gimmick. For a lot of buyers, it's the only door that opens. But here's the catch. A scheme changes when you can buy not what the home costs. You carry a bigger loan sooner. The repayments are calculated on the price the scheme helped you reach. A smaller deposit never replaces serviceability. The bank still stress tests whether your income survives higher rates, and honestly, that's a fair test to run on yourself before the bank runs it on you. The census makes the drift visible. In 1971, about 50% of Australians in their late 20s owned a home. By 2021, it was 36%. Same age, same country, a different market underneath them. And that shift lands on every kind of table. Renters on one income, regional movers, migrant families who started the race midway through. The same maths arriving differently at every front door. It even changes the map. For some households, the honest answer is a smaller place near work. For others, it's a bigger place further out or a regional town with a shorter deposit runway. There's no single right shape. The trade is honest in both directions. Closer usually means smaller. Further usually means commute. Neither is a failure, they're just different prices paid in different currencies: space, time, and money. So here's a question worth sitting with while you watch. In your household, is the real barrier the deposit, the cash wall, or the repayments, the monthly wait? They're two different problems with two different levers. Now the sober part. Because a video like this shouldn't just make you feel better about waiting. Buying later has real traps, and pretending otherwise would waste your trust. We found 3. National researchers followed people who bought late, many caught up. But the gap doesn't always close. Part of the ownership shortfall at 30 can still be there at 50. Later is absolutely possible. Automatic catch-up is not. That finding sounds heavy, but we read it the other way. It's a reason to plan properly, not a reason to quit. The buyers who close the gap tend to be the ones who bought deliberately, not desperately. A mortgage signed at 38 has less runway than one signed at 28. A bad purchase, a forced move, a suburb that doesn't fit, there are simply fewer working years left to absorb the mistake. Which makes the third trap the expensive one: borrowing the maximum because the maximum is offered. The approval number is what the bank can defend. The comfortable number is what your household can sleep on. They're rarely the same number, so we now ask for both in writing: the most we could borrow and the repayment we'd still be comfortable with if life got messy. The gap between them is your honest measure of risk. And if you've already stretched to the ceiling, that's not a verdict on you. The whole system nudges people there. The useful move is simply knowing which number you're standing on starting today. So here's what replaced the age deadline for us: 6 checks. They tell you whether you're ready, whatever your birth year says. Grab a pen for this part. 1. Total cash at settlement, not just the deposit, stamp duty, legal fees, and a buffer for the first surprises. We've watched savers hit the deposit target and still come up short at exchange. Count the whole wall. 2. Those two borrowing numbers, the maximum and the comfortable, written down before you fall in love with a listing. The listing always wins arguments you haven't had yet. 3. The stress test. Could the repayments survive if rates rose a couple of points? That's exactly how the bank judges you, so it's a fair way to judge the loan first. 4. The time horizon. Buying and selling costs real money, so the home needs to fit your life for at least 5 years. If a move is likely sooner, keeping your flexibility can genuinely be the smarter bridge. 5. The rest of your life gets a vote. Family plans, career moves, parents getting older. Buying in your late 30s often means buying midlife, not pre-life. The home has to fit commitments that already exist. 6. A plan B you genuinely accept. If this purchase falls through, is renting another year survivable? A household with a real fallback doesn't make panic bids, and that calm is worth actual money at an auction. Put together, it looks like this. Score it honestly. A couple of not yets isn't shame, it's information about which lever to pull: price point, location, co-buyer, or timeline. And one rule protects everything above it: run the deposit maths and the borrowing maths separately, then shop under the lower of the two ceilings. Age never decides this part. The smaller number does. When we ran our own version, the bank ceiling was higher than our cash ceiling. It was happy to lend more than our savings could safely anchor. Shopping under the smaller number cost us a bedroom on paper. It bought us sleep. Here's tonight's step, and it's free. Book a chat with a broker and ask for both numbers in writing. That single conversation converts months of vague worry into two figures you can plan around. Bring the honest version of your finances to that chat: payslips, real monthly spending, and every debt, including the buy now, pay later ones. The two numbers are only useful if they're built on the truth. Quick note before the finish: this is general information, not personal advice. A broker or licensed advisor can run your exact numbers for your exact household, and this decision deserves that. But the big picture holds. The typical first buyer is now in their mid-30s, and a fifth are over 40. You're not late. You're on time for the market that actually exists, and now you've got the checklist for it. If this helped map your thinking, subscribe. We put out one of these guides every week.